It's been a good 6-7 months since the collapse of IL&FS or the default of IL&FS, and since then concerns about NBFCs have come and gone, but they haven't gone away permanently for sure. There are lots of little accidents that could happen along the way. Joining us to talk about the NBFC space and also a little bit about banking is Ashish Gupta of Credit Suisse. His reports have become go-to reports to understand banking and finance. Ashish, thanks for taking the time.
Thanks, Ira.
Ashish, your latest report focused on NBFCs, and you said not out of the woods. Yes. But where are things? I mean, are they looking worse than they were 3 months back? Are they the same?
So, as you rightly pointed out, that it was about 8 months ago, 9 months ago, then that concerns on the NBFC space first surfaced, and that kind of got triggered by IL&FS and highlighted the ALM problems, right? But since then, a few things happened. There was a lot of liquidity deficit in the market that was addressed by the RBI. There was significant amount of liquidity injections. There was also some step up in the bank lending to NBFCs, and that helped them tide over their ALM mismatches and particularly meet their CP rollovers, etc. And in fact, most of the repayments till March got taken care of. But since then, what we find is that while the macro liquidity has been addressed, the debt markets have not significantly opened up for all NBFCs. And we find that ability of NBFCs to raise money from the debt markets is still patchy. So while some NBFCs have consistently been able to raise money over the past few months, some NBFCs have not. And this is a point of worry now, because after the 4-5 month lull, again we are coming into a period where there is significant amount of repayments that are coming up. So over the next 3 to 5 months, there is a big step up in repayments, particularly to mutual funds that is due from NBFCs. As you know, mutual funds are one of the largest providers of credit to NBFCs. For mutual funds, NBFCs account for nearly a third, actually now less than that, about 27% of their AUM. So it's the biggest part of their portfolio. And what we are seeing is that given the bunching up of all this news flow and potential credit events, the inflows into debt funds have been very meager. In fact, at the margin, there have been outflows. So the ability of mutual funds to continue funding NBFCs either for growth or even for rollovers is getting constrained. And therefore, I think the next 3 to 6 months is potentially more challenging than the last 3 months.
Okay. A couple of specific questions. So I think the number you put was 1.3 lakh crore in repayments coming due to mutual funds. In the current context, is that a large number? In a normal time, it perhaps is not a large number, right?
Yeah. So if you look at the total mutual fund industry, the debt mutual fund AUM is about 11 lakh crores, right? And so the 1.3 lakh crore number is not an outlier. This is the usual kind of cyclical repayment that is due. But what is challenging now is that banks are also topped up in terms of amount of exposure they have to NBFCs.
Oh, they are.
Right? So many of the state-owned banks have about 10 to 12% of their loan book already to NBFCs. So their ability to take incremental exposure to NBFCs is limited. The mutual fund, as we talked about earlier, are seeing some challenges on outflows, so they are not willing to increase exposure. In fact, they want to cut back exposure. And truth be told, their exposure to NBFC about 6 months ago was 32% of AUM. It's already been pegged down to 27% of AUM, but they want to peg it down further. And I think more than the aggregates, the bigger problem is that there are certain NBFCs, certain repayments that are coming up, where the debt markets, including mutual funds, don't want to carry on with exposure, right? So 1.3 trillion would not be as much of a problem if it was all to NBFCs, where mutual funds or the broader markets are comfortable with the exposure, but it is to some names where the markets doesn't appear to be comfortable.
Okay. So what are the fundraising options that are there? Securitization was actively used last year, but
Yes.
a lot of that, the good part would have already been securitized and sold, right? So how much can securitization yield for some of these weaker players?
I think securitization can still release a lot of liquidity. But before we get to securitization, let me highlight the couple of other options. So beside bank credit, another route for the NBFCs is retail bond issuances. So that also has got stepped up since last quarter. Another avenue that's been increasingly used is forex borrowings, ECBs, and as you would have seen, the forward premiums after the two swap operations from RBI have also come down. Therefore, it becomes easier and fairly cost effective for NBFCs with decent rating to be able to tap this route. Coming specifically to securitization, I think those NBFCs which have large retail asset pools, they have ability to securitize, and they will continue to do so. They might lose a bit on margin, but at least fund availability will be there. The challenge will be more on those NBFCs that have a large share of corporate assets. The second challenge that comes up is that while you may have a lot of retail assets in your portfolio, but if you continue to sell out or sell down your retail assets, the share of corporate in your loan mix increases. So theoretically, if some NBFC sells down retail assets and goes down from 60 to 40 in terms of their share of retail assets, then the debt market and also the credit rating comfort with that mix of asset book may not be there. So there might be implication on credit ratings for those NBFCs. So they will have to balance the two out. How do you kind of meet the liquidity challenge as well as keep the comfort in terms of on-balance sheet mix of loans?
I know you won't want to talk names, but there is a good 5-6 NBFCs, HFCs who will be in this a little bit of a spiral, right?
Yes.
They're not growing because they don't have liquidity.
Yes.
They're selling down their retail assets, so their wholesale assets are going up. That is creating another round of problems. So it seems like a cyclical problem, which I'm not sure how you break.
Yeah, so I think two ways to break this, and these two ways are not mutually exclusive. One is some sort of equity intervention. So if you bring down the leverage of these entities, the debt market comfort with them goes up. Similarly, to the extent you can sell down some corporate portfolios, or you can sell some parts of the balance sheet. So many of these NBFCs have decent assets, equity investment. We have seen some deals that have already been done, some which are talked about. So you need a fast conclusion of those deals that will both release liquidity as well as equity. The second part of the solution, I think, needs to come from the regulator. I think the regulator shied away from doing a comprehensive asset quality review the last time around in September, October. But I think that is needed, because the fact is that rightly or wrongly, the debt markets are not comfortable with all NBFCs. Right. So if there is a stress test or an AQR or whatever name it is called, if that helps in restoring credibility to the balance sheet of the NBFCs, at least the debt markets become open and available to them.
Okay, so you think they should be put to that test both on the on the liability side and also on the asset
because
side?
I think without putting them to that test and without restoring the credibility, if they continue to be shut out from the debt markets, that's a bigger disservice being done to them. Right. So even if there is some hole in the balance sheet, if you do that, at least you know that once that hole is filled, the debt markets will become open and available to them. Okay. If any financial institution does not get access to credit, then they have very limited runway.
What about, there was talk about some sort of change in asset liability guidelines, although nobody really understood what was coming. Nothing has come. Is there something that you foresee or think there is a need for?
So I think obviously those guidelines can be tightened. But frankly, at this point of time, I don't think that is an issue, because the events of September or August of 2018 have already enforced that discipline on the NBFCs.
Okay.
So most of these NBFCs are out of the shorter term market. They don't have access to commercial papers, etc. as much. So the market forces have addressed that ALM mismatch already. But I think now what market needs is more comfort on the solvency issues, where some sort of stress test, etc., might be helpful.
A question specific to HFCs. I mean, it's a little worrying to see HFCs go into D, and then Reliance Home Finance is at D for long-term facilities. DHFL is continuing to see ratings pressure. I mean, that was actually considered to be the safest pocket, right? And it has implications on housing finance availability, real estate finance availability.
So I think if we look at the core asset of these HFCs, which is the individual mortgage book, I think in none of the NBFCs we are seeing there's a discomfort with those particular assets, right? I think the discomfort and the rating downgrades that we have seen have originated on two accounts. A is the wholesale exposure of the developer exposure that has been added to some of the HFC books. And second is liquidity issues that are there in some of these HFC books, right? But as regard as the individual mortgage businesses, I think that continues to be proven time and time again to be one of the safest assets in the banking system. So I think going forward, one learning people might have to take from this is that even if HFCs is 75% retail, 25% corporate, you have to see it as a hybrid rather than entirely as a mortgage book.
Okay, and also there's promoter risk in all the entities where there's been downgrades, right? Yes. I mean, I don't know.
But that's manifested in form of liquidity risk, right? So those guys have had challenges in raising liquidity.
Is there a fallout already being seen on this real estate segment? Because I'm assuming they're not growing their books, so they're not growing their books to realty as well.
Yeah, although we have been surprised, one or two NBFCs have still been aggressively growing their real estate exposure, but most NBFCs have fortunately pulled back. We have seen some increase in reported NPAs also from the real estate space, but of course that is probably one pocket that is going to see the maximum amount of stress, because NBFCs were the major provider of credit for the segment. Banks also lend to real estate, but they lend at a much later stage. They are more lease and discounting, etc., rather than construction finance.
Okay, so that is something to watch out for.
Yes,
what's the overall growth picture for NBFCs and HFCs going to look like in FY20 to your mind? And again, will the market be very segregated? The Bajaj Finances, HDFCs will continue to grow and the others?
Yeah, so I think that's what we kind of try to highlight in our report, that till now, while the market has been very segregated over the last 3 months, some have got consistent liquidity, some have not. But if this manifest itself in terms of accelerated outflows from mutual fund, etc., then even for the good entities to get liquidity for growth might become challenging, right? So they might have to pull back on growth itself, because their funders themselves are constrained for growth, right? And our view, therefore, is that at least in the next 12 months, the share of credit supply that will be coming from NBFCs will be constrained. And thankfully, we have had big recapitalization of state-owned banks. Some banks have also come out from PCA. So we are hopeful that at least the bank credit growth will be better than what we have seen in the past couple of years. So already you would have seen bank credit growth is now 12-14%. It's much improved from 12-18 months ago when it was mid-single digits. So hopefully that helps to pick up some of the slack of the NBFC growth. But we believe aggregate credit growth will still be somewhat lower than what was the aggregate credit growth, that is bank plus NBFC credit growth put together about 12-18 months ago. But more than aggregate, the issue again will be which borrowers get adequate amount of credit, right? Because banks and NBFCs don't necessarily lend to the same set of borrowers. So if NBFCs are not lending, some borrowers might not get credit as easily or at the same cost as they were earlier.
We've seen some NBFCs trying to move down the banking route.
Yes.
India Bulls trying to get into a merger deal with LVB. You think that's a route that others will try? Do you think the regulator will be sort of open to that route? In the past, they haven't.
Sure. Yeah. So again, I won't comment on the specific incident, but the regulator has, in fact, in the past allowed some NBFCs to convert to a bank. We have seen Bandhan converting, we have seen IDFC converting, many of the microfinance companies have converted to small finance banks, etc. So I think the regulator has been open to that. And I also believe that particularly as NBFCs become larger and they become systemically important, it is in regulators' interest to ensure that they have a stable source of funding, because we have seen in the last 12 months wholesale credit markets can blow hot, blow cold, right? So so that can be challenging, and as you know, many of these NBFCs are no longer small, right? And they are literally a systemic important. So you need a consistent, stable source of funding, and a banking platform does provide that. A banking platform also provides for the more, I believe, stronger regulatory framework as well as closer supervision of the entities. So I would think ideally there should be a route that after a certain size, all NBFCs are forced to convert to a bank.
But there is a route, right? You can do a new banking license, but this seems like, doing mergers seems like trying to avoid some procedure.
No, I don't think it's anyway kind of backdoor entry, because I'm sure the regulator will require all the same conditionalities it looks at when it grants a new bank license. So whether it's a fit and proper criteria or all those requirements will be required to be met from anyone who's being considered through a merger as well.
Okay. Ashish, a couple of last questions on banks. We thought we were done with most of the cleanup, and now there are a whole bunch of, not very large, but still, the 3 or 4 assets which you pointed out in a subsequent report which are creating problems. Yeah.
Oh, so definitely there are some of these additional stresses out there. But I still think that unless we have an accident in any NBFC, the total trajectory should still be downwards. Many of the assets that we are talking about, many of the stresses that we are talking about, fortunately or unfortunately, are not exclusively exposure of banks, right? So their exposure of NBFCs, their exposure of mutual funds, etc. So not necessarily banks are as impacted by these as were with the some of the exposures 3-4 years ago. So unless banks get impacted because of some NBFC facing an issue, I don't think our overall trajectory of NPA reduction for banks should change.
So that reduction continues.
Yes.
Recoveries, you've been tracking IBC also very closely. Yes. It's not the best case scenario that people had hoped for, surely.
No, I think last few months have been a big disappointment. I think whether it's on account of infrastructure constraint or some inconsistency in how the IBC has been interpreted and some of the orders given, there's quite a discernible slowdown in the pace of resolution. So I think recoveries continue to be a challenge.
So ceteris paribus, we see a year where credit growth from banks remains strong.
Yes.
NPAs continue to come down
Yes.
moderately.
Yes.
And NBFCs, well, we hope for that there isn't another accident.
Yes, absolutely.
All right, Ashish, I'll leave it at that. Thank you so much for joining us.
Okay, thanks, Hina.